Good morning, everyone. Want to welcome you to Season 7, Episode 2 of HdL Sales Tax Trends and Economic Drivers. We're still letting some other folks into the webinar, so we're just going to wait about a minute before we get started. Glad you could take time in your busy schedules to join us today, so just give us a moment. We have, as usual, a lot of content, and we're certainly looking forward to any interaction that you would like to provide us along the way. I think I'm just going to end our pause here and go ahead and move forward with our presentation. I'm pleased today. I'm Ken Nordoff, one of the principals on the sales tax team, and I'm thrilled today to be joined by my colleagues Ken Brown and Tracy Vesley, who will actually be carrying most of the presentation content. I think many of you know them as your client services representatives. We're thrilled to be with you today. Just briefly about our company, we have this in every webinar. We've been working in California for over 4 decades, have literally hundreds of clients, very positive results, generated a lot of revenue recovery, and we're thrilled and pleased that we have been able to retain a high percentage of our clients over a long period of time. So let's get right into the results. We're going to be talking today about first quarter 2026. This would have been January through March sales taxes of this year. And you can see that there are some pretty noticeable increases when we're comparing this quarter's data to what occurred back in 1Q25. We had estimated 1.2% growth back in March, and that was developed at a time right after the Iran war had started, and we were anticipating some consumer slowdown or pullback over the remaining weeks of the quarter. But as you can see in the results here, things turned out at 4% growth compared to the year ago period. Many of the industry groups, and we're going to walk through these details in a minute, were positive. And most notable is that the county pool was almost half of the revenue growth in this particular period. We've got a number of indicators here that are influencing our forecast considerations. We've seen and continue to anticipate strong business investment. A lot of that is anchored to things like data centers and AI technology. We've seen some rebounding, particularly in the area of general retail that had a slow 2025 year and has started the year off strong. We have other economic indicators in here that continue to influence our outlook around things like inflation, the unemployment situation in the state, interest rates. We've obviously got these wars, international conflicts that have a global impact on the local economy in California, and that is not quite red, but certainly a big cautionary item. And then gas prices here, we tend to list these in red from the perspective of the consumer, knowing right now that gas prices, and Ken's going to walk through this in a minute, are very elevated compared to a year ago. But keep in mind that the consumer pain is in reverse to what you might anticipate in terms of your sales tax revenues from that group. So we'll go through that in some detail here. I've got some slides here just to kind of give you the macro perspective on what's happening in terms of economic indicators. This first one is looking at the personal savings rate. And you can see here, I've kind of circled at the bottom. We've got inflation recently that continues to outpace wage growth, and it's forcing more reliability on consumers to use credit. And we've got an economy that's been propped up really by two things. Big equity market increases have generated a lot of wealth, and some of that is being spent out of higher income households. And so those things are influencing personal savings. It's at a point here recently that's about as low as it's been only compared back here to what went on in the pandemic and then what we saw in the Great Recession. So savings rates are definitely at a low point. Some of the other integrated components here on the left is a bar chart that's showing 6 of the 7 last quarters that disposable personal income growth has been on decline. And it's BMO economics here is suggesting that that trend is showing a pretty major erosion of purchasing power that's well underway and is a concern, at least in terms of looking forward. And the chart on the right is showing a gap here between real personal income in the light blue and personal consumption or spending. And so that gap, again, has widened here on the right and to a point, again, where they're acknowledging this is at a level that really hasn't been seen outside of the pandemic or the previous housing bubble that occurred back in 2007. So all that said, BMO is still anticipating growth, but again, that's going to be anchored a lot to higher income earners or households and have definitely an influence depending upon where the stock market is headed. You probably saw that under the new chair that the Feds met recently and did not choose to change the rate that they established. It still remains between 3.5% and 3.75%. They feel that the economy is expanding at a solid pace. Job gains have kept up with the workforce. There's not much change in unemployment. And the committee's message was that they are focused on delivering price stability. I did do a little research and note a lot of the economists based upon that result have made some shifts, Bank of America being one example, where previously they had not expected a Fed fund increase this year. They now think there might be 3 of them in 2026 at the 0.25% levels in September, October, and December. So there are a number of folks that are thinking there may be some future increases trying to keep inflation under control. Those of you on the call with us last webinar will recall that we have taken this U.S. recession chart, kind of a forecast or a sense of where that was. And it was like 35% really over the previous quarter when we were talking to you back in March and April. And that has been on a steady decline and has been as low as 12% in this month of June. This chart shows 15%. And I think that trend from a consumer perspective is also indicative of why we saw such strong growth in the overall performance of sales taxes this quarter. This is our statewide outlook. And so this summarizes 16 quarters or the last and upcoming 4 fiscal years. You can see in the prior 2 fiscal years, we had some nominal decreases in statewide sales taxes. And given this quarter's results, and particularly the first 2 quarters of FY 25-26, we're really recovering from declines in the year ago periods. This quarter is a bit of an outlier. We definitely are going to see a positive result when we look ahead to the last quarter of this year and into next year. We're expecting sales tax revenues to continue to grow. We're now going to break that down by looking at a series of our 8 business groups, and we're going to begin with Ken Brown talking about fuel. So I'll hand it over to you, Ken. And you're on mute.
Thank you so much, Ken. I really appreciate it. In terms of our last presentation, when we sat here 3 months ago, we've really been on quite a roller coaster. We saw maybe 6 months ago even, we were talking about how there was a potential for a glut in world oil prices, just with the United States, with the fracking technology becoming really the world leader in oil. And then boom, 3 months ago, we had the Iran conflict start, oil prices soared, and now how the story turns, we've got the 60-day MOU. And so you see how that is reflected here in the price of oil over the last year. You can see the big run up here uh, when the conflict began, and then the drop over the last few weeks as the MOU came together, supply fears eased. So oil has come back down significantly, and in fact has been trading pretty close to pre-war pricing recently. Gas prices also falling, but gas prices are always the last thing to fall, and it can take a long time. We all know how that works. Now, here's the part that I find most interesting. This is the global picture in terms of world oil reserves. So in our webinar 6 months ago, when we talked about the United States energy dominance in terms of being the leader in global production with fracking technology, that was pressuring prices, but then the Iran war began. And so all of a sudden, so the U.S. Energy Information Administration revised its forecast. This is their forecast here in green before the war began. And then in dark blue, they just updated this in terms of global world reserves as of this month, as of here in June. So, you know, even with this new MOU that we've got, the 60-day MOU, reported progress and negotiations and trying to get to that next step, we still think that prices will be supported as these global oil supplies are restocked. It can take, you know, a couple weeks just, or a couple months to get global oil reserves. They can be depleted very quickly, but then it can take a long time to build them back up. So there's also some real risk here. Negotiations can get derailed, hostilities resume. So certainly the situation is much better than what it was when we met 3 months ago, but there's still, we're still not out of the woods. What is presented here is a graph of crude oil prices on the futures market at various future expiration dates. Recent pricing here is shown in the dark bars, while 3 months ago when we met, we presented you the futures curve here, the pricing curve back at that time. So that's 3 months ago. So this is really the commodity market's best guess as to where oil prices go from here. And the two major takeaways I have from this is, you know, first, the good news is the price curve does slope down, meaning that the market expects prices to ease over time. But interestingly, compared to where we were when we presented the same information to you 3 months ago, it hasn't changed as much as you would think, given that everything that has transpired in those 3 months. So big roller coaster, but the market is still projecting kind of a slow, easy drop in prices over time. So, and as we talked about, that always takes longer to trickle down to gas prices. So putting it all together, our fuel forecast is here. We're calling for higher year-over-year receipts for the next 4 quarters. Prices stay elevated against a cheap, low comparison last year. We're also reflecting certainly a level of risk in the forecast with several different parameters at play. Ultimately, though, we believe our projection we taper down and turn negative once we expect reserves to be restocked sometime in the future, and then slowly the situation normalizes over time. All right, so turning to autos, this is the auto major industry group. Years ago, Toyota Priuses, among the top selling cars in California. Most recently, Teslas, the top selling vehicles. Really, to me, a great representation of the fable of the tortoise and the hare. And I've owned both of these cars in my life, and they're both great cars. Recently, on September 30th, we talked about this in our last webinar. If you were with us, the federal EV tax credit went away. And so what happened? The slower and steadier Prius is now taking the lead again. And so you see that here in a chart showing changes in first quarter California vehicle registrations by make. And you can see that Toyota was the only make with a positive increase, with every other makes down in the first quarter in terms of vehicle registrations. Really led by the Prius, but not just the Prius. Nowadays, Toyota Camry, every single Camry they sell also is a hybrid system. And then they include their renowned hybrid system in many other of their models as well. So they are really doing well in this environment where the federal tax credit for electric vehicles has been cut. And meanwhile, gas prices are high. But you see here, the EV pure plays according to California registration data, down 24%. And so here's the other big takeaway that I really want to highlight for you, and it's a puzzle. With registrations down 9% this quarter, how is it that actual California sales tax in our database is up 1%? So we have fewer cars sold, but more revenue. How does that happen? Well, part of the answer is timing. Registration data doesn't always line up cleanly with sales. So there's certainly a lag in posting of that information. So that's a big part of the story. But what I really want to focus on is another aspect of that story, and that is pricing. And so pricing has gotten very expensive, as we've talked about over the last couple of years, hovering right around $50,000 per vehicle, which is dramatically higher than what it was before the pandemic. You don't see that data that far back on this chart, but it was about 38,000 back in 2020 before the pandemic. And several things have been working to push up prices. Of course, materials are more expensive. Cars are more loaded up with fun stuff than they used to be. And people, of course, keep gravitating towards those bigger SUVs, pricier, bigger. And so the mix is also an important factor. But there is another factor that I do want to revisit, tariffs. About a year ago in the same webinar, we flagged the new auto tariffs, and we said we'd keep you posted on their impact. And I'll be honest, it is really hard to cleanly segregate the impact of the tariff piece from all those other inputs on pricing pressures. It's all really tangled together, but it is a factor, and it may be showing up in a sneaky place, and that is in the vehicle destination fee. This is the charge that is added beyond the sticker price for the manufacturers to ship vehicles to the individual dealerships, and it is non-negotiable. These have been creeping up, as you can see on this chart, for years, but lately they've been climbing even faster, and it certainly is an easy way to increase prices without touching the headline price or the MSRP. Here that the average car is about 50,000. Part of that story is fees like this one that are quietly nudging the price higher in a very subtle way. And I think there's another aspect to this that is important to note, and that is that for quite a while in the last couple of years, auto manufacturers have been absorbing cost increases in material, tariffs, and other factors in their profit margins. They grew very profitable coming out of the COVID pandemic, but we're now way down in terms of gross profit margins. We're down about 60% in terms of profitability, in terms of the margin, all the way down to 3.6% in terms of their margin, which is not only lower substantially than what it was just a few years ago, but also lower than what it was years before that. And so here's the big point of this, is that as long as these automakers can absorb costs, they will do so. But with margins this thin, down to 3.6%, we expect more of the cost pressures to be passed along to customers, which means prices keep climbing. And that's a big reason why we expect this trend that we've been seeing of fewer cars sold, but sales tax that is flattish to up, to continue for a while. In terms of what the forecasting firms are projecting about unit volumes of vehicles sold in the United States, they all cluster around the same place for 2026, which is a little bit lower than what we saw in 2025. And the reason for that is that 2025 results were really juiced by people rushing out to buy cars ahead of the tariffs, ahead of the EV tax credit expiring. So certainly some of these sales got pushed back into 2025. But even so, we are still well below the pre-pandemic norm of about 17 million cars sold per year. And that's for the last couple of years. So cars are very expensive and people are holding on to them longer. And so all this stuff and all those factors go into our forecast. The big one, though, in terms of what I anchor my thinking on around this, is vehicle age. And so we're now at about 13 years. You've heard me say that before in previous presentations. So that is very old. And as well as cars are made these days, it is certainly a certainty that they will not last forever. And at some point, these will have to be replaced, and people can't keep putting that off forever. So demand will continue to build over time. And so that plays into our forecast that you see here. Pretty flat for the next couple quarters for the reasons I mentioned. Prices are high, affordability stretched, consumers are anxious. But beyond that, we believe tax receipts from vehicle sales start growing back towards more normal levels. So basically, we've seen now 3 years of declining prices. We believe we're near the end of that recent market correction with healthier growth coming soon. Shifting to building and construction. And yes, again, if you've been with us during recent webinars, you are tired of hearing me talk about housing affordability, but I keep coming back to it because just like with cars, affordability is a big part of the story for this group as well. And this is a new chart, but I found it really fascinating. Look at this. This is US existing home sales. This is where we're at now. They have now fallen to a level that we haven't seen, instantly kind of linking to some of the data Ken presented a little bit earlier at the beginning of the presentation. We haven't seen this since the Great Recession. And you'd have to go all the way back to around 1997 to find recent activity this low. So as we've talked about before, a lot of people are locked into mortgage rates that they don't want to give up, and newer trade-up buyers are locked out or scared off by high pricing. So this affordability problem has really gotten everybody's attention. It was certainly front and center in the recent California governor's primary this year. We heard a lot about that. And there's a lot of push to do something about this, both in California and nationally. And so many different proposals are being explored, streamlining approvals, making it easier to build ADUs, even a new $11 billion housing affordability bond headed to the November ballot in California in November. One of the hardest things with housing, though, is that we still basically build homes the way we always have. It's basically stick by stick, kind of an artisan process on site. It really hasn't captured the cost savings from technology the way that other industries have, which is why I found this anecdote from the city of Norwalk very interesting. They've got a new project going up near City Hall. The developer calls it the largest residential modular project in North America, which means project components are built in a factory, then assembled on site. So while the present is challenged, just like with autos, the long-term points to a push to build more housing and certainly new ideas on how to do so, pointing to some more development and construction activity ahead. And so this is another thing that really caught my eye. We're seeing big acquisitions of home builders recently. The most recent one that really stood out to me, Berkshire Hathaway, Warren Buffett's old company, agreed to buy Taylor Morrison. So why did this resonate with me personally? It's because I remember being in a city budget office back during the Great Recession. It was bleak. We were desperate. It was dark. Right at that time, Berkshire Hathaway bought Burlington Northern Railroad, and Buffett at that time called it an all-in bet on the future of America. And it became a symbol to me and many others that maybe the worst was behind us. So perhaps you could see the Taylor Morrison deal in that way. There have been certainly some other acquisitions in this area recently. But before we get too excited, I also need to note that Berkshire is sitting on a ton of cash right now. They are very conservative in their positioning. So while this may be a long-term vote of confidence in housing, we could certainly still have a bumpy ride. And that's what our forecast projects here. Turbulence for the next 5 quarters. Not much change overall, but longer term, we're more optimistic about this category than what you see up here on the screen for the next year. It appears now that there's a real structural push for more housing, and we believe that additional demand could be unleashed eventually as market dynamics slowly improve. Finally, my last group, the food and drug category, and results here keep coming down, pretty uninspiring, slightly down to flat. But there's a lot of interesting things happening underneath the surface here. Traditional grocery is getting squeezed. There's also a lot of innovation in this space, a lot of premium stores opening, specialty stores, international stores are flourishing, and you see it everywhere. In terms of the K-shaped type economy, you saw that Amazon Fresh just shut down, but Whole Foods planning a major expansion, including a return to Encinitas after closing there about 10 years ago. We also see new Whole Foods stores planned for opening in cities like Eastvale, Corona, and other cities around the state. They're also even beginning to develop a new small format store concept that they call Whole Foods Daily Shop. And then there's the international markets, H Mart, Tokyo Central, Northgate. One example that always sticks out in my mind, Mercado Gonzalez by Northgate in Costa Mesa, 70,000 square foot store, but it's really much more than that. They've got food, fresh made churros, a stage with music much of the week. It's really like a restaurant, store, and entertainment venue all in one. So it's a lot of fun. And you know, there's many other examples. Massive H Mart store, I think last year in Westminster just opened, and now a bigger 100,000 square foot location plan for Fremont, as I understand. All right, so our forecast for this group really reflects little change overall, despite all of that innovation. People are shopping differently, but they're still spending roughly the same amount of money in this category overall. Our forecast reflects that flat outlook. So that concludes my portion of the webinar. I am pleased to turn the presentation over to my colleague Tracy to discuss our next major industry group. Thank you.
Right. Thank you, Ken. Awesome. I am going to immediately jump right in. I have a lot to talk about. By the time I'm done, you're going to be tired of my voice. I apologize in advance. I am going to focus initially now on retail sales and focus on general consumer goods, which is our large category for brick and mortar retail. But before I get really into the nuts and bolts there, I just want to highlight that retail is several different tax groups in California. And brick and mortar is just one of them. So here on the slide, you can see brick and mortar comprises 56% of retail. Online is 44%. And goodness, fast catching up. That has definitely been an area of growth, really rapid growth over the last 15 years or so. Within online sales, it has two primary components. So in-state fulfillment is 42% of online, and then out of state, and that is captured in the business and industry group, which I'll talk about in a moment, kind of the third arm of retail sales. And then 58% is captured in the county pools, the second arm of retail sales. So I'll be talking about that as well. All right, running 4 quarters, consumer goods totaling about 2.7 billion. 1.5 of that is brick and mortar sales. 1.2 billion is online. You can see how close that is now. And that is really probably going to change over the next 5 years as folks lean more into online spending. Another look at retail, kind of another high level look. You've seen this graphic before. I like it. It is a really good depiction of growth trend in both online and brick and mortar, and then total retail. So online is represented by the yellow trend line. It includes direct payments to agencies with fulfillment centers and indirect e-commerce that flows through the pools. As you can see, online sales have really, they're having their moment, right? They continue to grow every single quarter. We're seeing growth there really strong in the last 2 years. The green trend line is brick and mortar sales. It's been up the last few quarters, coming off a couple years of decline sales. And I'm going to focus a little bit more on brick and mortar in just a moment. That solid trend line there, this is both. This is in-store and online collapsed together. It's positive. The data is emphasizing that people are still spending, but they're picking and choosing where they purchase. We'll see that for sure when we discuss more of their retail trends. They're looking for value, they're looking for deals, and I shouldn't even say they, I should say we. And we're also looking for convenience, and that's where you're seeing a lot of the online shopping being preferred. Not only are we finding good deals, but we're also getting our stuff the next day, or sometimes, weirdly enough, the same day. So this is where a lot of that trend is. And it's easy. It's so easy to shop online. You do it on your phone. It's a little bit more of a challenge to have to drive to a store. Okay, I'm going to move on and get into more of the brick and mortar detail. For the first quarter, it was up 3.5%. That was a big jump compared to previous quarters. Definitely a little bit more than what we had forecasted, but we'll take it. This chart is looking at really the top categories of brick and mortar retail. Discount department stores, this is your biggest category. Saw some growth here. This grabs stores such as Walmart, Walmart Supercenter, Target, Costco, big volume stores, biggest category. Family apparel is along with variety stores, demonstrating the largest growth this quarter. I'll mention jewelry stores in a moment. They grew as well. But these two, family apparel and variety stores, are really where consumers are tending to shop the most. This is where you're finding value. Family apparel are stores like Ross, TJ Maxx, Marshalls. Variety stores include Dollar Store. And this is where people can get a little bit more for their dollar. Jewelry stores is an anomaly. We've watched this trend now for a while. A lot of this is really being driven by folks in higher wage earning categories, definitely buying jewelry. And a lot of this is in some of those higher end jewelry establishments. Biggest declines this quarter, it's kind of hard to see on this graphic, but home furnishings, largest. Electronic appliances in there. I will say these are generally large purchase sectors. People are pulling back. Consumers are just not spending on some of those big ticket items. Or if they are, perhaps they're doing some of that online. Correct. Pager. General consumer goods growth. So this is the annual compounded annual growth rate from first quarter 24 to first quarter 26. We use this formula because it kind of smooths out some of the ups and downs. You can see in first quarter 25, growth really shot down comparatively, and then up into first quarter 26. But when you take these 3 years into consideration, growth is really closer to about 0.5%. Still positive, but looking at it from this compounded annual rate kind of smooths out some of those anomalies. So small growth in brick and mortar retail, kind of the punchline there. These are busy graphs, I apologize, but they're really good stories. Consumer Checkpoint Bank of America is looking at credit card data. In this first graph, it's showing spending numbers starting to slow down in some of these groups, although still there's growth, right? It's just lower growth. The second graph, Exhibit 5 here, is year-over-year growth in transactions. Now, these are positive as well, but the growth numbers are way lower. So really what that is kind of saying is transactions are expanding, but they're below the spending growth rates, which kind of suggests that spending is being impacted by inflation or higher prices. So may see lower spending, but because the prices are high, we're seeing greater revenue dollars. An area that we look at in brick and mortar as far as our forecast is concerned is changing retailer guidance. Publicly traded companies will post their future guidance each quarter. their expectations for the coming year. Compared to last quarter, we saw a couple for big companies improve their guidance assumptions, and then a whole bunch unchanged. So still some hesitancy, I think, in the marketplace with regard to growth in brick and mortar sales. Lots of businesses have been impacted by a variety of variables, including protesting, but and just changing their construct as well and how they do their business. Looking at the forecast for brick and mortar retail, fairly positive. Last 2 years, we saw decreases in brick and mortar sales. 25-26, we're anticipating just under 2% growth. And going forward, pretty similar, just about 1.5% growth in upcoming quarters. So while it's modest growth, it's low, it definitely is a little bit higher than what we were seeing 2 years ago, kind of getting back to our baseline, making up for a little bit of that decline in prior years. All right. Let's dive into the pools. So I mentioned them as well. They're kind of that second arm of retail sales, as well as a number of other sectors. This chart is showing you the top industry groups in the pools: private party used vehicle sales, building and construction, business and industry, retail, and restaurant food delivery, which would capture things like Uber Eats and Instacart. They're considered marketplace sellers, so they get captured here in the pools. Obviously, B&I and retail are the two largest groups, and we saw growth in both of them this quarter. One footnote here, and I'll be noting it in an upcoming group as well, is as we get the data and look at that for the first quarter results, and we're trying to clean it up, we will notice anomalies in taxpayer reporting, audit corrections, errors. When we kind of account for that for the pools, that 10.2% growth, which is really large, actually kind of comes down closer to 6%. Still a very positive result in the first quarter, more even than what we had initially anticipated. But once we adjust for some of those changes, it looks a little bit different. What drives the pools? I mentioned business and industry, general consumer goods are the two largest groups. This graph is depicting B&I here in the blue, and what's driving those numbers are related to energy, business services, medical biotechnology, the light industrial sector. We'll look at some of that in a moment. And then when we look at general consumer goods, this is all e-commerce now. Marketplace sellers, the largest sector in that group. Specialty retailers, electronics appliance retailers. We saw a boost there as a result of an audit, statewide audit that was conducted by the CDTFA that moved money out of direct payment into the pools in first quarter of 25. So that definitely grew that group there. This chart is capturing the top business types within the pools. So I've moved away from the big groups into the actual business types. I mentioned marketplace sellers. They are by far the largest sector within the county pools, comprising almost $72 million in the first quarter. Their share is about 17%. They're up 13.6%. The largest growth this quarter we saw actually in energy, which is one of the smaller groups, very volatile group, big energy projects going on across the state, a lot of them in the Central Valley region, some in the Bay Area as well. And this quarter, instead of much of that going into direct allocation that gets captured in the business industry tax group, it came into the pools. And we saw a really big 25% jump this quarter in energy allocations. Other business types, many were positive this quarter. Really, the only two that were kind of slower in their growth included used auto sales, medical, biotech, electronics, all a little bit slower this year or this quarter. When we're looking at the forecast for the pools, we're looking at a lot of different variables, but right now e-commerce tends to be pushing the numbers a lot. In this audits conducted by the CBTFA have also boosted overall pool revenue. Funds coming out of direct allocation into the pools have boosted the overall bottom line. I mentioned energy a moment ago, big boost in first quarter. Definitely considering this going into the future, considering some of this being one time in nature, not anticipating this level of increase every quarter for sure. Business to business has been really robust in supporting pool transactions, medical, industrial, energy investments, all helping to boost the overall results. So looking at the forecast for the pools, pretty positive. Only, 2 years ago, we saw in fiscal year 23-24 a dip, almost flat, down 0.3%. Growth in 24-25, just under 3%. And then this year, anticipating a big jump. So 25-26 is capturing new revenues from statewide audits and perhaps some one-time payments that really boosted the revenues in the first quarter, for sure, a little bit in fourth quarter as well. Going into next year for 26-27, stepping down a little bit, pulling out some of those one-time payments, also normalizing some of that new revenue that is now flowing into the pools, but still a pretty solid growth estimate at 4.3% in the pools. Okay, I've talked a little bit about business and industry as well. This is such an eclectic sales tax group, 21 very distinct sectors. This chart is really showing the top sectors, but it varies. It also includes auctioneer revenue,